Sandeep Tandon, founder and CIO of Quant Mutual Fund, with us. Sandeep, we always love your conversations with us here at NDTV Profit. Let's begin with how you see what's going on right now. The US-China thaw is the biggest news right now for global markets. People are discovering that we really need rare earth and China can hold a gun to our head anytime they want. Do you think that these global troubles is what's keeping the Indian markets from reaching its full potential right now?
See, we are in a phase where we still believe that geopolitical volatility will remain elevated from longer term perspective. Today we can talk about rare earth, tomorrow something else will be there, because you have to understand this battle is not about trade. This battle is about how US and China are fighting for their supremacy. So it's a trade. This is battle about supremacy, supremacy of their currencies. Okay, supremacy on the technology front, supremacy on the defense front. It's a multiple front. If you recollect what happened in 1940 to 1960, how UK was the superpower and the pound was the reserve currency, and how US came back. US captured that territory. Something similar is happening where US is worried China is in a better position to demonstrate that. And if you really look at, this time, though Mr. Trump has threatened China a number of times, but China has not budged. Okay, rather US has to surrender. Okay, to avoid their inflation crisis, which is knocking the doors of US in a big way. So I think it's a battle which we have to understand much larger perspective. Don't look into the small challenges of trade. So once you understand that, then you will start getting better clarity what is coming.
Sandeep, good morning. Neeraj here. Always a pleasure talking to you. So what is your line of sight currently? I don't know what's the latest writing in that book which may have happened, but what is your line of sight based on what you've just told us from an investing parlance, let's say for the 6, 9, 12 months? Because now I believe, and you, while you run a mutual fund, have a keen eye out for gold, for crypto, for everything, right? So tell us a bit about that.
So if you see, like last few months, we have been writing, like 2 months back, we talked about in our fact sheet, in our write-up, where we said that US China is in trouble, emerging market is in a better position, and India is in a good situation. So if you really look at the way I look at absolute terms, one has to look at the market, but I think in the today's context, relative is more important. We think from a global perspective now, even US investors believe that India is a much safer place in the current turmoil. And that's the reason, if you really understand the liquidity flow aspect, when you look at any of the liquidity indicators we track or we build, we are seeing that money is actually shifting from US market. The Europeans are pulling out money. Even Japanese investors have pulled out. China anyway is pulling out continuously. So we are in a phase where cross-border flow, which was extraordinary in US in last few years, that cycle has peaked out. Okay, and when we say that cycle has peaked down, if I combine with the risk appetite cycle is also peaked out, which clearly means money will shift from high risk to low risk environment, which clearly means that Asia-centric emerging market will attract flows, and that will lead to a decoupling process. This is what we have written 2 months back, that India decoupling process has begun. Okay, from US market, or even I'll say even from the developed market cycle, India will gradually get decoupled. And this is something which we are harping on it, that India is relatively safe place. India remain buy on dips. If you look at rest of the people who were thinking that small cap will collapse, mid caps will collapse, and most of the family office, HNI virtually has given it at the bottom of the cycle. Now look at the vengeance they have come back. So I think we have to understand that something has changed for India. This is something which we explain through a perception analytic, that India perception is changing, and is changed from longer term perspective. That's the reason I always say India is expensive. India will remain expensive from a longer term perspective. If you ask me longer term perspective, it can be 3 decades. That's the longer term perspective. So you're talking about a 3 decades opportunity. Okay, even you discount that also, then we are talking about longer term cycle which is in your favor. So that clearly endorses our larger thinking that India remains buy on dip. Now every opportunity we have to participate. If you really talk about let's say gold perspective, okay, uh, though we have been very constructive in our book, we have written that October November 2024 gold will see unprecedented bull run. And this was written in 2019, and we have seen how beautifully it has played out. And very recently, we have said that 3,500 levels gold has peaked out from a medium term perspective. We expect 10 to 12% correction, and simultaneously, we talked about crude rallying 10 to 12%, which has already happened. Okay, so crude has already recovered 10-12% from the recent bottom. So I think what is very important to look for a larger perspective. Also, we have to keep back of the mind, but you also have to identify these near-term and medium-term inflection points also to try to trade better. Let me give you a small example. Now, in our multi-cap fund, we have to maintain 10% the precious metal exposure. So what we did, we have, since we have to maintain and we have don't have too many options, so we can't sell. We pruned down significantly, but we shifted from gold to silver. So as of now, we have 100% exposure of the precious metal in silver, not in gold, and that thesis played out well for us in last 2 months or so. So I think these are the small things actually helps you in generating alpha and protecting your downside. And this is something I always say, that macro is very important. People tend to ignore in this country about macro. People say, I'm a bottom up guy. How does matter what happens to crypto, what happens to gold, or what happens to yield? I'm focusing only the earnings of the cycles and the P expansion of sitting in India. I think that's a myth. Okay, because if the larger perspective that asset class is not in your favor, you may relatively do better, but in absolute terms, you will actually generate negative alpha. But coming back to the global macro perspective and other thesis which we also talked about, India is still in a risk-on environment. Right from January, we said that India is a mild risk on, and March we said is a proper risk on. We are still not saying is an aggressive risk on. Okay, it's a proper risk on environment, and globally still a risk off phase. So India started our risk off phase in July 2024, and we were very early to talk about that phase, and we actually changed our portfolio, and in between we underperformed also. What is more important to understand is that you have, in the business of risk, you have to be ahead of the curve. Okay, like in January we spotted US risk off cycle and say US market has peaked out from a risk perspective, and technology stock, particularly Nasdaq, we talked about, will has potential to correct 15 to 20%. It did correct it. That is come back. That's a different issue. Okay, what is important for us to understand, if you can identify these inflection point and can capitalize, though it is very difficult that everybody get everything right. We also say we 28% time we don't get it right, but 72% time we get it right, and that itself is a very good number. So macro really gives us the background. Let's say talk about how many people were bullish on in the beginning of March. People are worried. People are still worried. The market has rallied significantly. This is the way we classic behavior. When you convert these behavior thesis, also people have actually capitulated. Short buildup was very large. Okay, risk appetite has bottoming out. Liquidity was rising. The perfect background was there in the beginning March for a pullback rally, and which has played out very well so far for us.
So in your view, then, putting all of these things into perspective, Sandeep, do you think we are going to see this phase of range-bound volatility extending for a bit? Because one would imagine that the kind of trigger and the booster that has come from the Reserve Bank of India would play out in a little more solid fashion. It was beyond what most expectations were. We got a 50 basis point cut and a 100 basis point easing on CRR.
So, see, we have to understand, if we are looking at, when we say that entire 2025, the volatility will remain high, which means, and I also said at the beginning that this year you watch focus should be not on the equity market, focus should be on the global yields and global currency movement, and up to a certain extent, global wall indices also. So if you have tracked these market, then you could have got much more clarity. I still maintain that from a yields and currency perspective, they will be more volatile this year than the equities market also. And hence, we have to live with this thesis that employed walls of the most of the asset class will remain elevated, and will be a big range that will play out. It's up to us how we capitalize that opportunity. On various forum, I always say, make volatility your best friend. This invisible animal should be your best friend. Don't be get scared of it, because if you are scared of volatility, then you will do exactly opposite what market is demanding. So with that background, I think any sort of sharp rally in the market or any euphoric get built, you prune down your exposure. When you see a panic happening on the market, you rebuild, because India is buy on dips. So you will not go wrong. And this is the way I have seen some of the large institutions globally has worked very well, and LIC is a very classic example in this country.
LIC is a classic example. What are you liking, Mr. Tandon, in terms of the consumption story that is expected to play out? Do you think that it is time to look beyond the, what has been the favorite so far, your discretionary, your platform companies, your gold companies, or do you think that's still where the alpha remains?
See, yes, I agree both from the budget perspective and the recent RBI announcement, which clearly means government is infusing liquidity, government is boosting confidence, tax benefits are there. A lot of noise are still we are hearing that some changes can happen in the GST front, which clearly demonstrate that government has understood they have to boost the consumption. Okay, and the good news is that after 4 years we are seeing the rural economy is coming back. Monsoon forecast has been good. Rather, we are seeing very early monsoon as of now. So that background, you have to be constructive, but we also have to understand only 2 months have passed when the benefit has been just passed on the consumption front and the impact on the even on the RBI benefit. It takes time to really get past. One of the large bank has already announced the cuts in the FD rates. Okay, so we either way I look at that, I will remain constructive. It's very difficult to pinpoint this particular sector or this particular stock has to be identified at this moment. But what is very important, if your larger picture is getting more clarity, I think we are very clear. The consumption is the theme you have to play. The only thing which we tell our team internally as well, and we are very vocal about saying that you have to avoid all those stocks which were in the admired territory, or I think sometimes say to these are like fashionable names. We should owe these names whether they have a cash flow or not, but these are in fashion today. So all fashionable names I will avoid. Anything which has been the admired territory for last few years I will avoid, and I will like to add some of the names which has been in neglected territory and that the consumption cycle moving up, they will generate alpha for us and your downside could be limited. So our thesis is not a contra call, but more of a data driven call. We like to identify some of these names rather than getting too much excited what has done extremely well so far in last few years.
Sandeep, I want to ask you about the flows as well, but just a follow-up on this question first. So therefore, would it mean, let's say, I mean, I'm just trying to think, right? The last 3, 4, 5 years, platform companies have come back from those lows and have done very well. You could maybe argue energy transition as a theme has done very well. I mean, are these the quote-unquote fashionable themes, or are there others? We just don't want to misquote you.
No, I will not get into spots very stock specific.
Yeah.
What is very important, you have to identify where is the cash flow. We don't want to buy stories. Okay, some basic things we have been taught from early stages. Cash flow we have to look at. You can have a deferred cash flow over 2 years, 3 years, but if you don't have visibility of these cash flow and company themselves come and say we will not make money for 10 years, then why should we have to get too much excited about it? So we don't want to pay price to sales sort of numbers, okay, or something, or some new valuation techniques has come which becomes very, that's the reason I use the word fashionable. It's not justified in normal circumstances. Those are the names. See, when the cycle is in your favor, these stocks have also multiplied. They have already multiplied and they corrected sharply, and some of the stocks have come back. But they are winners also in some of the basket. It's not like I'm saying everything is bad. So you have to identify the winner where the cash flow visibility is better. P liquidation process has been peaked out, okay, or that cycle is also bottomed out in that sense. So you have to identify as a combination rather than saying X number or X or Y names looks very attractive to me. I'm only telling you avoid over ownership, okay?
Perfect.
Avoid stories, okay? If this is not come, okay, but next 3 years look good. We have seen calls, where people talk about, okay, we missed out this time, but again, visibility looks very nice for next 3 years. So those are the stories which you have to avoid.
Got it. Okay, Sandeep, a word on flows themselves, right? The SIP investor is staying strong, agreed. But the last 3 or 4 months now, on the lump sums, due to one reason or the other, we're seeing some pullbacks. Is that worrying? I mean, I believe there is no past history to kind of give us comfort here, but I'm just trying to get a sense from you. What's your sense? Is this a change from what's happened in the last 5 years, or is it just a small pause? What's your best guess?
So, Neeraj, you have to understand again. I will answer this question from a human side perspective. Okay, first of to understand on multiple forum, I will say the retail investor in this country has become more mature as compared to whatever we have seen in the past. Okay, and they have understood the importance of SIP. They have understood the importance of a wealth creation journey through equity market, and that is very deep rooted in his mind right now. And I always say every bull run has a leadership role. This bull run is led by retail, and retail has a very large base. Now, coming back to your point, the lump sums flows have been slowed down. So you have to also look at lot of people got very excited at the peak of the cycle. They got sucked in. It's a human way. At the peak of the cycle, majority people who are sitting on the fence, they also get sucked in. And when they get sucked in, and then they don't have patience for that much period because they are virtually coming at the peak of the cycle. So some of those investors are again realizing that they are able to recover their losses, or the whatever level they have invested, or the NAVs have come back to the similar level. So some of the exit will happen, and this is what we also understand, because some of the people who came at the peak of the cycle will like to prune down their exposure or actually move out also, because they never participate from the bottom of the cycle. But when market again makes a again hit a new lifetime high or cross previous highs, okay, then the cycle will change completely. The people who have sold will be again forced to participate, okay, because it's a human cycle. When people say, okay, market is a new lifetime high and I am still sitting on cash and I withdraw money, they will again going to force to get participated. So I think it's a phase. If you ask me, this phenomena can last maybe 2 3 months also, because people are just realizing they are getting back their money. Some people will like to encash that opportunity. Some people who are stuck will like to move out. But as I advise to long-term investor, India is a very constructive long-term story. Buy on dip. So if you even as I advise to a lot of people who virtually come at the peak of the cycle, I always say even you have entered the peak of the cycle, doesn't matter. If you have 5 year horizon, see, equity market is 5 10 year horizon period. Asset equity as an asset class, and equity investors should look from a longer term perspective. You do get answers, because after 5 years again you look at, because I have never seen any 5 year cycle even you have lost money in even the small cap also. In fact, you got the highest return in this space. So I'm remain very constructive with the background that something already has changed for India. India perception is very different what was there 10 years back or even 20 years back, forget 40 years back. In last 10 years also it has changed, and I think last 4 5 years also it has improved significantly. Today India is a force to reckon. Best of the global firm wants to participate in the India economic boom, particularly when it is led by demographic cycle, which is in your favor. So I think it's a constructive background. I always say don't miss out this opportunity
Oh,
if
surely.
you can't manage the short-term pain.
Surely, surely. But I just want to come back to something you said, where you said, Sandeep, you're not excited by what is fashionable. There needs to be a solid case for a long-term investment, and not just a story that of course, founders will have to tell and promoters will have to tell. In that case, what is looking solid to you right now? What are the spaces that are looking interesting, and one that has a lot more potential left to be unlocked?
So if I have to look at in the see, very very important in what background we are talking about. We are talking about a global turmoil sort of background where tariff war drama is going on, geopolitical noise or narrative is on higher side. With that background, I will prefer to play domestic stories. Okay, so I'll very very focus and believer that currently the large infra names will do very well. Okay, PSU as a theme which has will come back in a big way, is already back in the game. We also like hospitality as a space. Then we like consumption names. Okay, again, consumption is a very vague thing and very broad thing. So you have to identify individual stocks, not even sector. I think because 2025 is about stocks, not about sector. You will, in the same sector, few stocks will do very well and few stocks will not do well. That's the reason I'm saying it's about stocks, things you 25. Energy as a theme, we remain very constructive. And maybe it's despite noise which is there about related to pharma, we think Indian pharma, India generic company particularly, because US has no option but to buy US in generic from India. Okay, and hence we remain very constructive on pharmaceutical as a space. So these are the areas which we like to think. We have been avoiding IT right from January. We don't have anything. We think even from the current levels. Financial services firm, which we believe in, particularly the insurance sector, looks very good to us. NBFC, we have been talking about for a while. Relative to the banks, we think bank has potential to underperform the financial services index. So maybe NBFC and insurance will outperform the banks going forward also. So there's a thesis we have to identify. As I said, overall BFSI looks good, but we think private sector bank is grossly overowned space, most admired space. Now you can compare valuations are attractive, but relative to global markets, the P deterioration happens. So I like to participate where we think there's a great opportunity and my downside is limited. It's very difficult to gauge okay exact bottom, but we are seeing now they're in neglected territory and something is changing, the numbers are improving. I like to participate in these names rather than saying that something which is very expensive, grossly admired territory stock, grossly overowned stake name, but they are the talk of the town. Those are the names I will avoid.
Definitely. The talk of the town doesn't mean it's going to shine in your portfolio. Thank you so much, Sandeep Tandon, for speaking with us. Always a pleasure to have you on.
Thanks for inviting.